Hi, I am Apurva Sheth and I welcome you to yet another episode of The Right Choices with Oracles of Dalal Street. Our aim is to curate actionable and insightful strategies from real world stock market heroes so that you can make the right choices. Friends, so far we have focused only on equities in our show. But there is a market which is at least 25 to 30 times bigger than the equity markets. It is the commodity markets. And today we have a veteran from the commodity markets to talk about the tremendous opportunities it has for traders. Our guest for today is associated with financial markets for more than 30 years. He has worked with one of the largest Canadian banks as a forex and commodity dealer. He has also been a member of the advisory panel of MCX, and his weekly columns on outlook of commodity markets in business newspapers are widely read across the world. He appears regularly on business news channels to share his opinion on the commodity markets. Currently, he is the co-founder and CEO of Comtrends Research, which is an independent research firm specializing in commodities and currencies. So let's welcome Mr. Gnanasekar Thiagarajan ji to our show. Welcome to the show, sir. We are pleased to have you over here.
Pleasure is all mine, Apurva.
I'm eager to talk to you about commodity markets. But before we do that, I would like to talk about your journey in the financial markets. Now, I know that you have worked with companies like Dow Jones and Reuters before joining the Bank of Nova Scotia. So, can you share some of your experiences with the various organizations that you have worked with?
So Apurva, it all began back in the 90s, early 90s. When I joined a software company, which I think is not there in existence right now. It's called DART, D-A-R-T, which is Data Line and Research Technologies Limited. Basically, it was selling financial information software, basically providing information on all the listed companies in the Bombay Stock Exchange at that time. And along with that, it also had a collaboration with a company in the US called Equities International, which is very popularly known for its product Metastock. So that is how I started my journey in these markets. I was basically selling these products at one point in time, and it aroused my curiosity as to how market participants. And those days, these kind of tools were very rare to find, and very few people even knew about what technical analysis is all about, how to use it on markets. And I'm talking about times when there was open outcry. Uh, so
And those days, people used to plot charts on graph papers. So, software was something very new.
absolutely. So there were a few handful of people who really even knew how to interpret all these charts and interpret graphs. So that aroused my curiosity. I used to go sit with them and find out what they were up to. And some of them thought, this is a very secretive kind of an information. It should not be given to at least their competitors. But since I was from a software company, they looked at me as someone neutral, and they would whenever they had time, they would share their knowledge with me. And subsequently, I sort of joined a few other companies in the same line, but these are international companies like Reuters, Dow Jones. Now, Dow Jones is a publisher of the Wall Street Journal. That is where I came to meet a lot of companies, a lot of corporates, a lot of traders, specifically in trading in these commodities, and how these people were actually using all this information which we are providing in the terminal for their actual business needs, and how it impacted the business. So that kind of aroused my curiosity in a big way. And coffee was one of my earliest commodities, which I was very keen and very interested in. And because in South, in the Karnataka area, there's this coffee business which is very big. A lot of coffee exporters. So they used to constantly watch the New York the prices of coffee. And the terminals which we provide gave them all that information. So I used to sort of, just interpret my own ideas and tell them, see, coffee is going to do this, coffee is going to do that. and they would be amazed as to exactly how it's moving in line with what this fellow is telling. And I'm not from the industry also, so they would all call me, and we've had even sessions and stuff like that. That's what increased my interest in commodities. I thought if it could happen in coffee, why not in other commodities? So that's how my journey in commodities began. But essentially, my initial part of my career was in equities. So that's where I learned most of my stuff. And then I realized that many corporates in India use this commodity information, and they are affected by commodity prices whenever they rise and fall, as a consumer and as a producer. So that made me very keen, and I got a very good breakthrough into one of these very large corporates. I don't think they'll mind me naming them. It's ITC, which gave me a break. So for them, I used to very closely interact, and then they had a agribusiness division in Hyderabad. So I was helping them out in a great way, to analyze these markets, using technical analysis, using other information on commodities. So my world of commodities opened up only there. So I got exposed into international trading, how commodities are used for international trading. And this is much before MCX. So MCX came much, much later. But all this is pre 2004, 2005. And then subsequently, I joined Bank of Nova Scotia early 2000 as a forex trader and as a commodity trader. So Bank of Nova Scotia is the largest bullion bank in the world. So we used to sort of do the currency desk for most of these bullion traders, and even metals was there, base metals on the portfolio. So that's how I kind of got exposed completely into trading also, and that interest just grew more and more from there. But I must say that during the Dow Jones days, when I was with the Wall Street Journal, I came to meet a lot of these technical analysts, global ones, not the domestic ones. And I've had the opportunity of not just speaking to them, but interacting with them and working with them for some time. And that is the time when I would say that was the best part of my life, and picked up a lot of knowledge on technical analysis and how especially to apply it on commodity markets in the US. That was the best part. And then the bank gave me a lot of exposure. And subsequently, I sort of got out of the bank. And then MCX was just coming up, and they needed someone who could teach the markets at that point in time. And it just began. It was a very new story. What is commodities? How to trade it? And one single question kept on coming in all the CNBC interviews that I've done at that time is, if I buy soybean, will I get delivery in my house? This is, it took at least 3-4 years, including the anchors, including the investors. They had the same question, and it took quite some time to educate them. So that process took a long time, and I was a part of that process, helping the exchange build that awareness of what commodity is all about. And now my company Contrans provides research, and many of these intermediaries, I've helped them set up these research desks, the real top names. And now we provide a complete set of research as well as fund management to some of our institutions and corporates. We don't do fund management for equities, but we do for corporates and institutions because the risk appetite is quite big. And that's how this whole thing started.
Absolutely. So it's been a long and insightful journey into the world of commodities and currencies, and I'm sure that we are going to learn a lot of new and insightful things from you in this entire conversation. So looking forward to it. So my first question is sort of a myth breaker. Like, I know a lot of people believe that if you are an equity trader, you don't need to bother what's happening in the commodity space. But that is a myth, and that's a very wrong approach. Like, if you are a garment manufacturer, you cannot ignore what is happening in the cotton space. And if you are an auto manufacturer, you cannot ignore what is happening to steel and various other products that you use as inputs. So commodities, if these manufacturers cannot ignore the commodity markets, then how can you as an investor ignore what's happening in the commodity space? So I want your thoughts on how can analyzing or tracking what is happening in the commodity markets help an equity trader, even if you are not a active participant in the commodity markets. I'm sure equity traders can get some insights from the commodity markets.
Yeah, a very good question actually, because this is a dilemma which has been there with many investors, especially in the equity space. You're absolutely right in saying that everything is interconnected. You have to understand that all the commodity prices are essentially input for most of these companies, whether it be cotton, whether it be edible oils, whether it be pulses, whether it be energy, whether it be metals. So all these are input costs, and especially being an import country where we largely import most of these commodities. Of course, we are also exporters of many of the commodities, but we have turned largely an import-related country. Uh, so the price movements of these commodities are certainly going to have a big effect on the P&L of most of these companies. So that is a very critical thing, and understanding the cyclical nature of the commodities can also help one as an investor in equities to sort of catch the cycles. I'll give you a good example because this I'm telling you from my little experience that I've had. I also have clients very actively who participate in the equity market, very big investors in equities. And they take my views and strategies from time to time on commodity price movement. So this happened in 2016 or 17, I'm not sure, when the metal cycle was coming. I mean, the metal prices were at an all-time low. And there was a very clear sign that there's a supply-driven recovery which is going to take place, which means that many of these mining companies were making losses because the prices of commodities were at such low prices. So I sounded out many of my clients saying that they're going to cut production, which means that prices of many of these commodities will rise, metal prices will rise. And immediately, I think they went and bought specific stocks, which is, if my memory serves right, Vedanta, Hindustan Aluminium, and all those metal-related stocks. And metal prices just went up by around 5 to 10%, but the share prices went up nearly 100% in some of the cases. So that only goes to prove that if the commodity prices rise a certain extent, that's enough to impact the balance sheet in a big way. So the prices of shares can rise even much more than that. Which is why many of these punters, once they understand the commodity price movement, then they bet on the stocks rather than the actual commodities, because it tends to go rise much higher compared to the commodity itself. So that is one sort of an important thing to keep in mind. When you're looking at many of these companies, especially if they are commodity specific, like centric. Because even if you're a producer of any commodities and you're exporting it out, you have to know how it is performing in the global space. That is also important. So tracking global commodity prices is a must now. If you're just an equity analyst and if you're going to ignore that, well, it's doomsday for you.
Yeah, and you cannot afford to ignore it. And this thing works both ways. Like if you are a commodity producer, then how the commodity prices are moving will definitely affect you. But if you are also a commodity consumer, so let's say if you are a TTK Prestige or a Hawkins cooker, then you cannot ignore what is happening in the aluminium market. And if the aluminium prices are rising, then there could be drastic repercussions on these companies. I'm sure they will also have some or the other things to manage their input costs. But even so, producers as well as consumers both are affected. So by tracking one commodity, you can like track multiple companies as well along with it.
Absolutely. In fact, one commodity, for example, if you take cotton, I think it's got a huge impact on textiles. You have exporters. Uh, so it's across the board. It can have a wide impact on the economy as well as on the industry. And it's interesting that you said about the input cost. Most organizations in India at least, who I'm aware of, I work with many of them, are still not in the practice of hedging in any major way. Some of them do, but a majority of them don't. So they are exposed to price risk even though they are aware of all these things. Because the conventional mindset is that let just pass the price rise to the consumer and let him deal with it. So that's the trend so far. But as times are changing, as competitiveness is increasing among companies, now I'm noticing that many of them are taking steps towards managing this price risk in commodities, that it doesn't affect their P&L in a big way. So there are many corporates that I work with now who are seriously into hedging, and they put a hedging desk, and I help them out in many ways.
So another myth which is there related to the commodity space is that tracking and analyzing commodities are very difficult. So a lot of people say that equity markets are easier to track and monitor, but commodities are difficult. But they fail to understand that there is a very important aspect or characteristic of commodities, which is seasonality. So seasonality could make it easier if you know how to use that as a tool. So can you share your thoughts on seasonality aspect of commodities, and also along with it, if you can give an example of seasonality in a particular commodity and how you can use it?
See, the seasonality is pretty much same when it comes to equities and commodities. You get results in the month of April, May, June. Every year, most of the results of the annual results of the companies are published. And similarly, half-yearly results. So you know that these are the times when volatility will be high in these stocks. Similarly, for all these commodities which are demand-centric and supply-centric, you know that demand will peak at a particular point in time, and it will be a low at a particular point in time. Supplies will peak at a point in time and be low at a point in time. So I would say that the cyclicality in commodities is much, much more predictable compared to the cyclicality in equities. Simply because market participants know this information, the cyclicality of the commodities, and they all tend to behave in a certain way when the cyclicality happens. Now, for example, if you take crude oil, there are two important demand seasons for crude oil, which is the US driving season. Why it's very important is because in the US, the West Coast, East Coast is a long drive, and most of the jobs are in the East Coast, and they all come to spend time with the families in West Coast on Thanksgiving. So the driving season is during that time. So there are a lot of people who wish to drive all the way there. It takes sometimes 24 to 36 hours. But that's when the driving season demand picks up in a big way. Similarly, Christmas demand is very high. So the last quarter of any year is a very good quarter for demand as far as crude oil is concerned.
It also helps because of the winters. Like a lot of people, I had read somewhere that natural gas is also peaks in around December or January, because there's a lot of demand because of the winter season.
That's right. When I say energy, crude oil, I'm generally talking about heavy demands. So there is a clear cyclicality. One can predict that fairly easily. Generally markets tend to behave fairly predictable during these cyclical times. And every commodity has a cyclicality. It's not that it's specific to only crude oil or only to metals. Agriculture has its own set of cyclicality, and it's much more predictable actually. There's a crop season, and then after that there's an arrival season, and buyers will be waiting for this arrival season. So there's an amazing amount of predictability in commodity prices compared to equities. And it's not that it's predictable in a big way. It has its own risks and ups and downs. But if I relate it or compare it to the equities, I can tell you with certainty that it's fairly more predictable. But knowing the cycles are very important. You have to understand each commodities, specifically. What is the cycle? What is the demand? What is the supply? Then various other factors that.
Yeah, so there are a lot of factors that we'll talk about it absolutely. So based on those factors, we can predict the movement of these commodities. Yeah. So now Indian commodity markets are broadly divided into four categories. So base metals, precious metals, energy, and agriculture. In abroad, there are weather is also traded, but here it is not that much popular. So these are the main four categories. Now, can you give us a brief overview of what are the commodities which are very liquid and highly traded in each of these four categories?
See, in the non-agri commodities, which is basically precious metals, base metals, energy, and a few other commodities associated with that, natural gas, and few other commodities. These are the broadly bigger commodities in the non-agri basket. There are many of them. Some of them are illiquid, but these are the broadly high liquid commodities, and they all have an effective international price reference system. Meaning you don't need to, and it's not domestically moving. It's got an internationally referenced price, and most of the times, it moves based on that. There are very, very few times that it doesn't, and that is when the government policies happen. Like, for example, duty hikes that happen in gold during a budget time, and duty hikes and cuts both. Uh, and in metals, lately the contract has changed. In India, the MCX base metal contracts have changed. So partly it is moving with the domestic factors. If there is any supply demand mismatch in the domestic market, then even though international prices are rising, this might not rise. So there are times that happens, but largely it is moving in line with these international prices. And of course, energy is the leader in the pack. Even globally, it's like that. So if you look at the CRB index, or the Commodity Research Bureau index, which is a benchmark index for most of the commodities, the weightages are done at the beginning of the year. Now, Bloomberg Commodity Index is more famous. So the weightages are such that the first one, the very first weightage, or the largest weightage in the commodity basket, goes to crude, which is roughly close to 50%. And then comes, you'll be surprised what comes next. It's not gold, it's not silver, it's coffee. And then comes cotton. And then comes other commodities like gold, silver, other commodities. Why coffee? Because the very index is designed in such a way that any commodity which is widely accepted and widely used, the weightage will be more. So coffee is had all over the world. So coffee comes next after crude oil, because we use crude oil in everything in our life. So this index essentially is calculated at the beginning of the year, and most of these funds, which trade in commodities, the big funds, the big players, so they allocate based on this weightages at the beginning of the year itself. That for commodities, this is what we're going to allocate, and this commodity is this much percentage. So once that is out of the way, then there are individual desks which will be trading individual commodities. So that's how the non-agri complex essentially moves. And though non-agri commodities are specific to demand supply, the most important thing in any commodity is demand and supply. That is what determines prices. But in non-agri commodities, there is beyond demand and supply, which is essentially sentiment, the macroeconomic sentiment, and the dollar, because most important thing is the dollar here, simply because most of these metals, most of these commodities are priced in US dollars, are traded in US dollars physically, not in exchange terms. So the strength or weakness of the dollar has an impact on most of these commodities. Now, a simple thing any investor has to understand is that if the dollar's value keeps going up, then as a buyer of these commodities, my ability to buy that commodity will become lesser and lesser. If for X amount of dollars I can buy X amount of commodities, if the dollar strength increases, then the value of the commodity also increases, and the ability to buy that commodity keeps decreasing. which is why most of these commodities have an inverse relationship with the dollar. So
Yeah.
the dollar strength or weakness impacts most of the commodities simply because they're priced in US dollars, the physical, the underlying physical business. Uh, so that is the non-agri part. The agri part, of course, is largely physical trade, but has a very, very active market, and the participation in agri is specific to that industry and a few other funds who know about that particular commodity. Whereas in non-agri, you have all kinds of funds, keep betting on most of these non-agri commodities. But in agri, you would see specific funds who bet on it, who have some knowledge on it, who have some idea about what these markets are.
So it's mostly industry insiders who are trading the agri commodities.
Yeah, at one point in time, it was like that when there was the same open outcry system in the US also. For the pit trading, which happened in CBOT and other exchanges. At that time, it was all insider information. But now, of course, it's electronic. But I must say that, after the algo systems have become popular, uh, many of them have come into agro commodities. So most of them are already into non-agro commodities. So that has, to a great extent, disturbed the industry in many ways, because you've seen exaggerated moves on both sides. When it falls like as if there's no tomorrow. When it rises, there's so much of buying that as if that commodity is not going to be there tomorrow at all. There's no availability. So that's the kind of movement we're seeing thanks to this new animal called algo trading. So that's the broad classification between agro and non-agro. Agro needs some amount of understanding and expertise. Non-agro, I wouldn't say it does not, but relatively, I think if one were to start trading in commodities, I think you should start with non-agro and gradually evolve into other commodities.
So now, for someone who's just starting to trade or analyze commodities, so there are these factors which are very much important. So, like you said, dollar is one of the very important factors. So, dollar is spread all across, like all the various categories of commodities are affected by the way the dollar moves. Apart from that, there are factors like supply demand. There's this macroeconomic factors. So, I want that we can take one categories and then explain like what are the factors, crucial factors which are affected. So can we go and start with base metals? So what are the things that a newcomer should look at when he's tracking base metals?
So base metals, is basically ferrous and non-ferrous metals. Even in that, you have different categories. And what we have to realize is who is the biggest producer and who is the biggest consumer. These are the two critical information that you need to have for any specific commodity. Today, it's very easy to understand that China is the largest consumer of most of these products. They're also producers in many of the metals, but they're the largest consumers of most of the metals. Not that the rest of the world doesn't consume, but China consumes more than anyone else because of their focus on infrastructure, building infrastructure, and especially after the Beijing Olympics, this focus has been there. And they also have this very critical function called building reserves. So they have a strategic reserve which they have, unlike any other country that we've seen, where they keep buying these commodities as a nation and just hold it. Whenever they see prices rising and inflation rising and that impacting consumers, they will simply use the reserves and dump the market with that, bringing in reining in on commodity prices. So one needs to keep an eye on China and these developments that happen from time to time. That is very critical. And of course, the dollar, because the dollar is sort of an important puzzle that fits into this entire thing, simply because it's priced. Most of these commodities are priced in dollars, and the economic data that impacts the dollar globally, that has an impact on many of the commodities most of the times. So that is something one needs to first start tracking. what are the main economic data which the market looks at as far as the US dollar is concerned. So if you are able to get that in the first 6 months, then that's good enough. I think it will slowly lead you to other important data that is needed. But this is what the market largely focuses on as far as the factors that influence these base metal prices. And then you also need to keep an eye on the seasonality, on when there is peak demand. For example, pre-Chinese New Year, there is a lot of demand for some of these metals, and post that the demand goes down. And even September, October is a lean season demand. So for every base metal, there is a lean season and a peak season. So one needs to understand that. And see, when I say understand, today luckily you have the internet where everything is there. All you need to just Google and find out. I mean, 10, 15 years back, that option was not there, and we had.
So basically the problem with Google is there's a lot of unfiltered information out there, and as a beginner you would never know whether that information is correct or not, and that's the main purpose of doing this show with experts like you, so that our retail investors can get the right guidance and they can start their learning curve would be faster and smoother.
Yeah, so if you are basically a beginner, my advice would be basically start tracking the price. You don't need to do anything else, to be honest, because that's how I learned. I was very, very keen about the price movement, because when you start questioning why the price went up, why it went down, then you will automatically start understanding the factors that influence the price.
Mhm.
And over a period of time, you will come to know most of the factors that influences the price. So if you're a beginner, the first thing you do is you start tracking the price and start questioning. I agree with your point that there's a lot of information which is free, and you can't rely on it much. But there are websites like investing.com, and I can name a whole list of them, which provide really quality information on the markets, because sitting in India, it's very difficult to know what's happening.
Yeah.
Most of these global commodity, we also rely on information from many sources. So so these sources, you have to trust. Some of them you have to, like the international ones like Bloomberg, Reuters. Though those reports might be delayed on the internet, they're quite useful for investors who are sort of testing what.
Yeah, so people who want to understand can rely on these kind of reports. So we'll take the entire list from you, the resources that you've so we can.
Suggestion is definitely start tracking the price.
Yeah.
Because this is the easiest way of actually understanding the market. Start tracking and start questioning as to why it went up and why it went down, and start finding out what was the reason that influenced that movement.
So one of the things that you mentioned is that how the dollar moves and the factors which affects the dollar eventually leads to the movement in the commodity markets. So some of the things that affect the dollar are the unemployment data and US Fed policies. So what are the other things that affect the US dollar?
See, the non-farm payroll is the most important, which is mentioned. That tells how much of new jobs have been created in the US economy. And then you also have data on interest rates, the Fed policies that impacted from time to time. Over and above that, you have the ISM, which is the producers, the manufacturing index, also the retail sales index, on what the kind of sales that are happening, the retail sales. That gives you an idea as to how much of money that's being pumped into the economy, and how well it's performing. And a whole lot of other small economic indicators which markets look from time to time. Now, the dollar movement is largely focused on these big important data, and very few times it gets influenced by the smaller ones. So that also you need to know when which data plays a big role. In a time when there is not much of news, and it's very quiet, then it focuses on every little thing. But when the market is full of information, then it focuses largely on the primary data, which is non-farm payroll, which is the ISM index, the retail sales. But every day there is an economic release. There's not a day which passes where there is no economic data that comes out. So the market has some dope or the other to keep on looking at every day. Uh, so it's a big list. I mean, I can just go on and on with this. But primarily, if you start tracking these data which you just talked about, I think that's good enough. And the CPI data is also very important, which kind of gives you an idea about the inflation and the interest rate hikes, the possibility of hikes and cuts. So that's primarily what moves the dollar. And of course, the statements from most of these officials of central banks and the central bank policies and in which direction it's going. And the markets typically tend to start betting on, when I say dollar, it is only betting on the interest rate of many of the currencies. So whatever it is doing based on this economic data is only trying to predict if the interest rate will go up or come down. Because that's how money flows. If it flows towards higher interest rate currencies.
So if the interest rates rises, the money will flow over there.
That's right.
So now we have spoken about base metals. Now, similarly, just like base metals, there are also precious metals, and a lot of things are very common. Like the movement of dollar will affect precious metals as well. But apart from that, there is this. If I talk about bullions, then the Indian festival season creates a lot of demand. So is there a seasonality aspect to bullion as well, closer to our festive season? And what are the other things that affect the bullion prices?
See, in my 15 to 20 years of trading in bullion, I've seen very few instances where the Indian demand has had a big impact on international prices.
Mm-hmm.
The jewelry demand is always there. It is something which the market is never surprised about. Only if it goes down, it's surprised. So we've been, like, if you look at the last 15, 20 years, we've been importing roughly 1,000 odd tons every year. There's not been much of a difference there in a big way up or down. So plus or minus, but the last 2 years it's been less due to COVID. But before that, the demand has been pretty much the same as far as jewelry demand is concerned. Which is for festivals, which is for Akshaya Tritiya, and auspicious occasions like weddings. So they have a seasonality, and some of them are throughout the year. But the largest demand comes in during Akshaya Tritiya in the month of March and April, and in the month of Diwali, which is November, December. November. So these are the two important demand seasons as far as the Indian bullion calendar is concerned. But till today, I've only seen few instances, when the domestic demand has picked up and that's had an impact on the international price. That has been very rare, very, very rare.
Mm-hmm.
I can only remember, when prices crossed 10,000 for the first time, and suddenly everyone is queuing up to buy more gold, and subsequently when it corrected and there was huge demand physically, that had an impact, but very, very rare. So it is important to track, but I'd still not give that much importance to it. I would still go with what's happening in the international prices. And the international prices, largely move based on the dollar because it's inversely correlated with it. Not just because it's the dollar and how it has an impact on base metals. There's a very different impact dollar has on gold. Simply because gold competes with dollar as an alternative currency. Which it does not as far as base metals are concerned. So even gold is priced in US dollars, so the gold price gets impacted by dollar strength and weakness. But it also competes with the dollar as an alternative currency. Now, if you have a currency note or a dollar, and if you're anywhere in the world, you will still find it difficult to go look for a currency exchange to exchange the dollar. Whereas if you have a small piece of gold with you, you can do that in any corner of the street. So it has a wider acceptance as a currency compared to the dollar, even now. So which is why it competes with the dollar for as an alternative currency. So that's the key thing to understand. It's not just the price of the dollar; it's also about the alternative currency and how it plays a role.
So whenever there is a question mark on dollar, or whenever there is a financial market crash or something like that, then that's the point where gold starts moving, or at least there's some talk about gold during that point of time.
Yeah, so it has a safe haven appeal where even all the assets are not doing well. Then people tend to move towards gold as a as a safety, as purely as a measure of safety, like an insurance policy. So you have, like, you keep paying premium to an insurance policy. Similarly, you buy gold and park it in your portfolio. It might come of use when you have such crashes, when you have geopolitical events. So that's the time when generally market or investors run towards the safety of gold. Uh, but these are not events that are going to happen every other day. So you need to keep an eye on these safe haven. For example, now when the equity markets are at a peak, and you don't know, any news can trigger it, and being such a largely leveraged sort of a market. Uh, this is the time when most investors would park money in gold, because you don't know what is the impact of this correction, and once that starts happening, then you will see a good amount of risk. Now what you're seeing is risk appetite, but just the exact opposite will happen, and people would start parking money in bullion just to be on the safer side as a safe haven. That's about it.
So we have come to an end of this conversation with Thiagarajan ji. In this episode, we have seen his journey into financial markets. After that, we have also busted a few myths with respect to commodity trading. After that, we have also seen a few factors which affect commodity markets, and one of the most important factors is the dollar. In our next episode, we'll also delve deeper into the factors which affect commodity markets, and we will also see how technical analysis can help you trade commodities in a better way. So do stay tuned and look out for our episode next week. Meanwhile, you can like this episode, share it with your friends and family members who want to become better commodity traders, and do subscribe to our channel so that you can look forward to our interesting videos in the future as well. So thanks a lot and have a nice day.
So the point is, stick to those commodities which have an international influence, and which is basically the edible oil space. The edible oil space is a very, very active space overseas.